Good morning everybody and welcome to my YouTube channel. Today I will introduce a series of strategies which can be applied in difficult times like the one we are seeing right now. When markets are crashing, how can an investor save his previous investment and try to profit from the situation? If you are keen on this topic and you want to know the details of the strategies, please send me an email at the address you find below, pisatimatteo@gmail.com. I will be extremely happy to answer your question and provide all details in a subsequent webinars. Thank you for the attention. Let's start. First tip of the day. Is it time to re-enter financial markets? Short answer, no. I expect that the final drop in financial markets will occur when the coronavirus will spread in US. So in this current moment, we are seeing the virus spreading dramatically in Italy and in other areas of Europe like Germany, France and Spain. Still, in US the epidemic is still quite contained and limited. This means that a final drop is expected when the inevitable will occur. After that, we have to be aware that rebounds will occur, will take place exactly when central banks and governments will take measures to boost the crumbling economy. Importantly for investors, while these rebounds will be extremely violent, they will not revert the trend. So I expect positive daily returns in the range of 4, 5, even 6%. But I don't think that before the final drop, which is expected in 1-2 months max, there will be a change in the generalized direction of financial markets.
The second tip of the day is how to make long-term investing during a crisis. Let's suppose you have previously bought 100 stock of Apple and IBM for a total of 100,000 US dollar, and you believe that they will perform well in the future because they are solid firms. So that's the assumption. You have your own portfolio, which was created before the crisis, and you believe in this portfolio. You know that the stocks you included inside it are very good. They will perform amazingly in the long run. But what to do nowadays during the crisis? Well, you can protect yourself going short on the future on the S&P 500 for 100,000 US dollar. It basically means that you are retaining your position so you avoid selling there in the worst moment when there is a low liquidity, and so you have to sell them at a huge discount. So you don't touch them. But going short on a future on the index, you are protecting yourself by the fall of the market. So that's extremely interesting way to protect yourself while retaining untouched your portfolio. And when the crisis passes, the only thing you have to do is to take a long position on futures to cover the short position on future on the index, and you basically are back in the previous original situation, and you can profit for your long-term views. The third and last tip of the day is about stocks betas divergence during a crisis. First of all, what is a beta? The beta of a stock, let's say stock I, is defined as the covariance between the returns of the individual stock and the returns of the reference index, divided by the variance of the returns of the index. Now, by definition, the beta of the reference index must be equal to 1. What is important to know, first of all, is that stock can be classified accordingly to their beta. If they have beta which is less than 1, they are called defensive stocks, while if their beta is bigger than 1, they are called aggressive stocks. Why this happens? Because basically beta tell us which is the exposure of the individual stock with respect to the movement of the reference index. So if the beta is bigger than 1, it means that the stocks amplifies the movements of the index, while the vice versa apply if the beta is less than 1. So, first of all, invest in defensive stocks during a crisis. But the most interesting part is the dynamics of beta. Indeed, when a crisis hits the market and volatility spikes, something very curious happens to betas. Precisely, while some stocks observe a spike in their beta, other stocks which are included in the reference index experience exactly the opposite. And the stocks which had a previous spike in beta are the one who are expected to perform relatively worse. So you have a very powerful signal on how to rebalance your portfolio right at the beginning of a crisis. In such a way, you can avoid losses, you can even profit and make a tons of money going short on the stocks which experienced a spike in their beta right after the beginning of the crisis, and going long on the stocks which are more or less stable in terms of beta, or even better, on stocks which experience a decline in their beta. But if you want to have a sound estimate of beta, we cannot use all available data as it was done years ago. My suggestion is to use a simple rolling window, employing just the last 2 months of daily returns. This measure is very effective, simple, but extremely powerful in providing you a very robust signal about the relative performance of stocks during a crisis. Is everything for now. Bye bye.